Welcome to this explainer. Today, I'm stepping in as your skeptical, data-driven equity research analyst to break down the actual financial reality of Smurfit Westrock's post-merger landscape. We've got full access to their recent earnings, medium-term investor updates, and credit rating reports, so we're going to look right past the PR spin and do a real forensic investigation of the financial statements to figure out, is this packaging giant a long-term value play or just a near-term value trap? But real quick, before we open up the ledger, here is our mandatory YouTube compliance disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. All right, let's dive into our agenda. We're going step by step today, starting with the newly merged company's grand thesis and management's 2030 vision. Then we'll crash right into the gritty reality of their Q2 performance, the squeeze margins, and that balance sheet debt, before locking in our final analyst verdict. Section 1. The packaging behemoth's thesis, scale, strategy, and market moats. So post-merger, Smurfit Westrock is the undisputed global heavyweight in fiber-based packaging. I mean, we're talking about a staggering $31 billion in revenue and a $25.9 billion market cap. With 97,000 employees spread across 40 countries, their exposure is heavily weighted toward non-cyclical, fast-moving consumer goods. And, in theory, that gives them a massive defensive moat. They aren't just making cardboard boxes here, you guys. They are controlling the entire value chain, from recycling all the way to sourcing and production. But look, as an analyst, I've got to balance out this narrative. On one hand, you have incredible long-term tailwinds. The whole global shift towards sustainability and plastic substitution, that provides a permanent demand driver for their recyclable products. Add in geographic diversification to smooth out economic bumps, plus vertical integration for raw material self-sufficiency, and it looks great. But then you flip to the near-term headwinds, and they are fierce. We're talking severe freight inflation, rising energy costs, and a really frustrating lag in their ability to actually pass these costs on to consumers. So the ultimate question for us today is, which of these forces is stronger right now? Moving on to Section 2, the 2030 financial vision, management's aggressive projections. Management is pitching an incredibly ambitious growth target right now. They expect to close out 2026 with roughly $5 billion in adjusted EBITDA, but by 2030, they're aiming for $7 billion. That's a 7% compound annual growth rate, alongside an expected margin expansion of 300 basis points. But here is the major catch we found. This entire plan assumes perfectly flat current market conditions. It assumes market growth of just 1.6% in North America and 1.7% in Europe, with absolutely no major price increases in paper. It's a model that completely relies on internal execution and cost synergies rather than getting lucky with the macroeconomy. Their capital allocation roadmap is basically designed to be eye candy for long-term investors. They're promising to generate $14 billion in cumulative discretionary free cash flow by 2030. And what are they going to do with all that cash? Well, they're targeting $5 billion in cumulative dividends over that period, and they've signaled that they'll have the capacity for share buybacks starting in 2027. It's a beautiful roadmap on paper, right? Well, that's assuming they can weather the current storm. Which brings us to Section 3, the Q2 reality check, cracks in the thesis. Now we strip away the PR spin. During the latest earnings release, CEO Tony Smurfit heralded the tightest industry supply conditions in recent years. Now, if you follow commodities and packaging, you know that tight supply normally signals one thing: massive pricing power and booming profits. High demand, low supply, you raise prices, margins expand. Seems pretty simple. Yet, despite that really bullish quote, the stock fell off a cliff, abruptly plunging 6.61% following the Q2 report, dropping to $47.44 in pre-market trading. Why? Because the market saw right through the optimism directly to the underlying margin decay. Investors aren't paying for what the supply conditions should do, they are paying for what the numbers are actually doing. Let's break down their $8.03 billion in quarterly sales. They generated $1.14 billion in adjusted EBITDA, which sounds pretty decent. Until you look at North America, their biggest segment. North American corrugated volumes actually shrank by 4.8% on a days-adjusted basis. Europe and Asia-Pacific barely eked out a modest 1.5% volume growth. Honestly, the only true bright spot was Latin America, which delivered an exceptional 22% margin. But overall, sluggish volumes and creeping costs forced management to lower their full-year EBITDA guidance range to between 4.9 and 5.1 billion. Let's dig into exactly why in Section 4, squeezed margins and rising costs. Dissecting the EBITDA bridge. When you look at an EBITDA bridge, which is just the step-by-step breakdown explaining why Q2 profits dropped from last year, the damage is painfully clear. Volume improvements added a measly $14 million. But below that, a staggering $90 million was completely incinerated by surging freight costs. Energy costs took another $22 million bite. And worst of all, despite those tight supply conditions we just talked about, lower selling prices actually drained $60 million from the bottom line. They simply haven't been able to execute their pricing power fast enough to outrun inflation. And honestly, it gets worse for the near term. Management is projecting a massive $300 million full-year headwind just from freight costs alone in 2026, alongside another $220 million drag from energy costs. Now, they have announced price increases in Europe and for containerboard, but the reality of customary pricing lags means these benefits aren't truly going to hit the income statement until 2027. Section 5. Dissecting the balance sheet, navigating the post-merger debt load. This right here is the anchor weighing down the stock. Following the mega merger, Smurfit Westrock has $14.25 billion in total debt sitting on their balance sheet as of March 2026. Now, just to put that in perspective, prior to the merger in 2023, that number was just $3.74 billion. That is a colossal leap in leverage. Essentially, the cost of building this industry behemoth was piling on $10 billion in fresh debt. So, how are the credit agencies viewing this? Well, Fitch Ratings recently affirmed the company at a BBB+ rating with a stable outlook. Management's stated goal is to bring net EBITDA leverage under 2.0x, down from where it sits currently at 2.6x. However, Fitch notes a pretty huge challenge here. Free cash flow margins are stubbornly low, expected to sit around a mere 1% for 2026 and 2027. Plus, they only have about $350 million in recognized cash on hand. Because they're fully committed to paying out these heavy, progressive dividends, their ability to organically generate the cash needed to rapidly pay down that $14 billion in debt is seriously constrained. Hitting their leverage targets relies heavily on flawlessly executing $400 million in merger synergies and having incredibly tight discipline on their capital expenditures. All right, let's wrap this up in Section 6, the final analyst verdict, synthesizing the fundamentals. Okay, we've looked at the grand vision, the Q2 reality, the margin squeeze, and that massive debt load. Objectively, what we have here is a classic tug of war. On one side, the company possesses a legitimately expanding economic moat. Their unrivaled global footprint gives them efficient scale, and that raw material self-sufficiency offers a distinct cost advantage against smaller competitors that are the undeniable heavyweight champion of a highly defensive market. But on the exact opposite side of the ledger, this looks like a very treacherous near-term trap. They're running with high capital expenditure intensity, about 7.5% of their revenue. They're suffering from a severe delay in pricing execution, while freight costs absolutely torch their margins, and that $14.25 billion debt severely limits any short-term financial flexibility. So I leave you with this final thought. The structural fundamentals point to a formidable long-term moat, for sure, but the hidden cost flags and the heavy debt load suggest we are sailing straight into an immediate margin storm. So, are you willing to wait it out until 2027 for those price increases and share buybacks to actually materialize, or is the current freight and debt reality just too heavy to hold? Which side of the ledger are you on? As always, do your own homework. Thanks so much for joining me on this explainer, and I will catch you in the next one.